If you work in the banking industry, you might have heard of funds transfer pricing, but you might not know what it means. So here's how it works. The CEO of a bank needs to be able to evaluate the different business units of that bank based on their profitability. So you want to look at the profit of the residential mortgage division, the profit of the credit card division, commercial mortgages, and so forth. But here's the problem. How do you evaluate each unit's profit when you have the Treasury Department managing the liability side of the balance sheet and therefore generating the interest expense for the bank, and then you have the other units, whether it be credit card, residential mortgages, and so forth, that are managing the asset side of the balance sheet and therefore bringing in the interest revenue. So you've got one department that's basically a cost center. It's bringing in the interest expense. And then you've got the other units that are basically a revenue center. They're bringing in interest revenue. And to calculate the profit, we really want interest revenue minus interest expense. But the Treasury Department doesn't have any interest revenue, and the other units don't have interest expense allocated to them. So funds transfer pricing is going to solve that. So it's a mechanism for allocating the interest expense, the cost of funds, to different business units, whether it be residential mortgages, credit cards, and so forth. Each business unit is going to get allocated some of that cost of funds, some of that interest expense from the liabilities that the Treasury Department is managing. And then interest revenue is going to be allocated to the Treasury Department. So now each department can be evaluated as an independent profit center. Okay, we're trying to convert a cost center, the Treasury Department, to a profit center by allocating it some of the interest revenue, and then we're trying to turn the other business units into profit centers by allocating them some of them the cost of funds, okay, the cost of those liabilities. Right now, here's the thing. To determine the cost of funds for each business unit, it's really complicated. But what happens in short is the bank creates this thing called a cost of funds curve or a funds transfer pricing FTP curve. And what it does is it assigns a higher cost of funds to business units that happen to have riskier products. So for example, let's say we have a bank and the division, the business unit with the riskiest product happens to be the credit card business unit. So then the credit card business unit would be assigned a higher cost of funds than the other business units when it's time to allocate some of that interest expense that's generated by the liability side of the balance sheet to each of the business units.